I am very confident that prices will head much higher in 2026, except there is one factor that could completely change that prediction. And if you have property or you're looking at getting into property, this is one thing you need to be paying attention to because APRA is making some massive changes. And the last time they did, we saw one of the biggest declines in property prices in the last 30 years. So in this video, I'm going to go through exactly what APRA's announced. It is red hot in terms of the topic, and it's not due to come in until Feb, but it's something you need to pay attention to, especially if you're looking at scaling up your portfolio in 2026. If you're interested in what my thoughts are, definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. Now, for anyone that doesn't know, APRA is the regulatory body that actually goes and governs these banks that give us loans. Now, the last time they got involved was around 2017 and 2019. And the massive changes that came off the back of it meant property prices actually fell. So yes, when you look at supply and you look at everything else that's playing out in the market, we should see prices much higher in the next 12 months. But if APRA come in and they come in strong and hard, changing the rules around lending, that could completely throw out any predictions that any economist has right now. So let's go through exactly what they're proposing. I'm gonna make sense of it, make it really simple, and then I'm gonna summarize it all at the end because I know you absolutely love that part. So let's jump into it. Now, APRA had a media release which says, APRA is to limit high debt to income home loans to constrain riskier lending. The Australian Prudential Regulation Authority will limit high debt to income home lending to preemptively contain a buildup of housing related vulnerabilities in the financial system. While overall bank lending standards remain sound, APRA has observed a pickup in some riskier forms of lending over recent months as interest rates have fallen, housing credit growth has picked up to above its longer-term average, and housing prices have risen further. Combined with a resilient labour market, these trends suggest a shift in the financial risk cycle and a potential buildup of vulnerabilities that could undermine banking sector and household financial resilience if left unchecked. In particular, high DTI, which is debt to income ratio, lending has started to pick up, albeit from a low base driven by high DTI loans to investors. This is expected to increase further in the next part of this cycle, and already high household indebtedness could increase further. Given these dynamics, APRA is acting now to contain the potential buildup of housing-related risks from high DTI lending by activating a DTI lending limit with the support from the Council of Financial Regulators. Okay, a lot of words there. I'm going to break it down exactly what's going on. Now, in 2016 and 2017, we saw prices starting to move higher, but you saw a lot of risk being taken in those markets. And I remember at that time, because I just bought another property and I'd been investing for a while till then, and what I saw was you could go in and talk to one bank and then effectively get a loan but not have to say anything to another bank. And then there were other things like you didn't have to disclose, deposit amounts were so much lower, and interest-only loans were going through the roof. Debt to income was not really a thing that was being enforced. So what it effectively means is how much debt can you borrow based on the income you have. Now, a general rule of thumb is about 6. So if you go 5 to 6 is usually what the DTI should be. So if you wanted to know what your borrowing capacity was in theory, you would say, okay, if I make $100,000, you times that by 5 or 6, and that is what my borrowing capacity would look like. So if you're making 100K, you could borrow up to 500K or up to 600K. Now, during times of 2016 and 2017, DTIs were jumping up to like 8 or 9. So the same 100K borrower is going out there and borrowing for $800,000 or $900,000. Now, if you've been following this channel for a while, I talk about how the prices are related to how much lending is available. So when interest rates started going up so quickly, you also saw banks start taking on a lot less risk. Because of that, we saw prices start to stagnate, especially in markets like Sydney and Melbourne. So if you think about it, it's like a water tap. So as you loosen up the taps, more water flows through. As more water flows through, it goes into assets and asset prices go up. Now, the reason why we saw such a big decline in property prices in between 2017 and 2019, during that time we had a balanced market. It was pretty healthy. You had vacancy rates close to 3%, and on the housing demand and supply side, we had high levels of approvals and completions when it came to supply. So it was a balanced market. So really, if you had anything pull that out of whack, you would see prices either decline or increase. Now in this case, APRA comes in, looks at the market and goes, hey, you guys are doing some dodgy shit. So what we're gonna do is we're gonna now implement all these limitations as to what you can and can't do. As a result of that, banks sort of pulled back. You have a lot less credit coming into the market, and this was our GFC moment. And the reason I say that is because when you look back at 2008 and 2009 global financial crisis, it was off the back of subprime mortgages, which effectively meant that people were borrowing so much debt, but they didn't really have the assets or the income to back it up. So the housing market collapsed, and off the back of that, you had the banking issues as well. Now, in fact, a lot of people think we're on that exact same path, but I would go on to argue if you looked underneath the hood, we're actually in a very good position, and I'm going to share some stats in a second. But when we were in 2016 and 17, if APRA didn't jump in, by the time 2020 or 2021 would have come through, I think we would have seen an absolute explosion in terms of prices completely drop. We'd have the entire market collapse. So it was actually a good thing. And in this case, negative news is actually good news. Now, I would go on to say that we're probably not seeing enough by APRA, but we're going to go through that in a little bit more detail as well. From 1st Feb next year, the limit on home loans will allow authorized deposit taking institutions to lend up to 20% of their new mortgage lending at debt of 6 times income or more. The limit will apply separately to ADI's owner-occupier and investor lending. At an aggregate level, the limit is not currently binding, so it is not expected to have a near-term impact on borrowers' access to credit. Only a small number of ADIs are expected to be near the limit for high DTI investor lending at this stage. Should levels of high DTI lending rise towards the 20% limit over the coming period, the limit will act as a guardrail and is expected to have a greater impact on investors who typically borrow a higher DTI ratios than owner-occupiers. So what this is effectively saying is right now, you can go out there and you can get the high DTI loans and no one's going to say anything. But from the 1st of Feb, the banks are going to come out and say, hey, only 1 in 5 will actually be able to go above that 6 DTI. And you're starting to see an issue here because that still means that 4 people miss out, the 1 investor can actually continue building their wealth, which now poses a really big risk. Now, on one front, it looks really good because 80% of people are still having to borrow less than the DTI of 6. But if you actually look at the numbers, this seems like an absolute nothing burger. And you got to look at this. So here what we have is the actual debt to income ratios for new house lending. And what you can see is in the orange, you've got more than 4 but less than 6. And then in the black, you've got more than 6. And what you can see is basically from 2022, you've seen that number decline dramatically. So we were really close to about 25% of all new loans were above 6 DTI. And the reason for that was because interest rate cuts allowed you to borrow that much. But since then, interest rates increased. And because of that, people can't borrow that much anyway. And that's why we've seen such a rapid decline. And the numbers are looking closer to about 5 to 7%, whereas what we're saying is 20% is the number that is going to be what gets flagged by APRA. Now, while this is happening, you've also seen Australian housing credit growth absolutely go through the roof. And you can see that with the orange color being investors, what you're seeing is an absolute breakout. And when you see this number go higher, we're definitely seeing a lot more momentum in the market. But what's crazy is to see this number go and increase while the DTI above 6 is decreasing. And I'm going to summarize what this all means, so just be patient. Now, if you are someone who is looking to go get a mortgage and you have no idea what this sort of stuff means, these only apply to the banks. So there are non-bank lenders out there like 2nd tier and 3rd tier lenders that won't even have to apply for this sort of rule. What you've got to understand is that there are so many solutions to sophisticated investors that you unfortunately are at a disadvantage whether you're going straight to the bank or you're talking to a broker that has no idea about sophisticated investing and different structures. This is why I advocate you need the right team. And it's not just about getting the loans and going out and saying, oh, I can buy any property. It's buying the right property with the right loan product. So I've got links in the description box below. You need to go out and get a team around you. I urge you to book a free call with my company, and it's gonna allow you to go and get a bit more clarity around what we do next. Now let's jump into exactly what I think of all this. Now, yes, it is true. The last time APRA got involved, the markets went down, but we were in a different time altogether at that point because again, we had a balanced market. Right now, structurally, we have an issue when it comes to supply. We've got incoming demand and that's not slowing down anytime soon. You also have existing demand that's looking for properties. And unfortunately, we're not producing enough. So structurally, we still have an issue. And when you actually reference how many loans are being written at above 6 DTI, it's next to nothing, being at 5 to 7%. Versus a couple of years ago when we were at 25%. So again, it's not really going to affect anyone. Now this comes in on the 1st of Feb. And this is why it is so interesting when you think about an opportunity in front of you. What this will do is it will push out people that actually want to borrow more but can't borrow more. So it presents an opportunity for people like yourself that want to go out there and not compete with as many people. Now that's one school of thought. The other thing to think about is that now you have an unfair advantage because now you know 80% of people that were now competing with you if you were going to go to a traditional bank are unfortunately out of the race altogether. So if you're someone who is the lucky few that can go out there and actually invest, you should invest. It's the same thing I've been preaching but also got taught as much as 12 years ago when I started buying in the first place. It's that when you can access equity and when you can buy, you should go and do those things. Because if the bank comes in and changes their rules, well, guess what? You can't do anything anymore. And now you're going to regret not having made the choice earlier because you had the option to do it. I've made this mistake myself because in 2016, I ended up buying a property and I was like, oh, cool, this will never end. And I had an opportunity to double down. Instead, I didn't. And then what happened was 6 months later, I unfortunately couldn't borrow again. And I couldn't borrow again for like 2 years after that. So this is something to consider. As you're going through this journey, know that you have the right people looking ahead for you. Because if you're not invested in this market completely, looking at it day and night, unfortunately you fall behind compared to the other investors and other people that do it full time. And if you don't have the time to do it full time, you need the team to do it. That's why I have free calls in my description box, because I ethically have to tell you that if I've got something that can help you, I want to share it to the world. Now, fortunately, we limit how many people we take on. You need to be fast with your hands. Just waiting by on the sidelines and hoping things will change because the government cares for you is unfortunately not going to do anything. My opinion on this is it's probably the first step APRA is taking. I would go on to say that we're going to see a lot more in terms of market intervention when it comes to late 2026, and I'm eager for it because every time APRA does get involved, we do see some volatility in the market. Those who are getting ahead get further ahead. Those who don't make a move get left behind. And unfortunately, we're seeing the death of the middle class. If you guys want to see a deep dive video around the death of the middle class, let me know in the comments down below saying middle class. I'll make that video for you guys. And if you liked this video, definitely go check out this one because this is the mindset you need to have if you want to go out there and make something of yourself in the next 5 to 10 years. Hope you guys have enjoyed this video. If you have, subscribe and I'll catch you guys on the next one. Thanks, guys.